Social Security at risk of being depleted in just 7 short years, plus Ray Dalio predicting an economic heart attack for the United States government, plus Bitcoin and precious metals continue to go bonkers. So we'll give you an update on that. Let's take a look at some charts that I want to share with you, beginning with a poll that was at the community tab. It's still up there at ETF Guide TV, asking you, what is your financial goal? This is one of those questions that has no wrong answer. And the vast majority of you responded, 48% to be exact, that you want to retire early, which is a very noble financial goal. I concur. I'd like to retire early. Although, I'm one of those people that I don't think I could ever see myself being like in the traditional sense of retirement, which is what some people think, just golfing all day long or just hanging out at the beach. That's not my vision of retirement. Maybe for some of you it is, which again, it's okay. But this was your answer. The other popular answer was to hit a certain dollar figure or goal for your retirement accounts. That was almost 40% of you. 9% of you said pay off my mortgage. And then let's drill down to the other posts. These were some of the comments for that particular poll, which were kind of interesting. Trucker is waiting for a housing market crash, wants to have enough cash to purchase a home, and thinking counterintuitively, I like it. Buy when others are selling, when there's panic, when there's blood in the streets. I wrote about that in my book, Habits of the Investing Greats. Being counterintuitive, that was one of the habits. Goose says survival. That's good, Goose, but I'd like to see you do more than just survive. I want to see all of you thrive, right? Not just live and survive, but actually enjoy the journey by thriving. Gary Hicks says he wants to pass along a 7-figure investment portfolio to his son. We should all have a dad like that. You're a good dad, Gary. We've also got Angel saying that they want to create a legacy, money plus legacy. I like that. Not the type to sit idle. Hey, that's me. I don't want to sit idle. Angel Crypto says Bitcoin XRP, which is Ripple and then cash. I don't know what this message means, Angel. I guess you want to have a lot of each of those things. And then D'Angeli says Lambo. Okay, nothing wrong with Lambo. My suggestion, D'Angeli, make sure you've got a backup car because the Lambo's not very reliable. They're fast, but not very reliable. And also make sure you have a good mechanic as well as a boatload of money for maintenance and insurance. There's still time, by the way, to comment on this poll. What is your financial goal? Again, hit that community tab at ETF Guide TV. So this was an interesting chart from the Congressional Budget Office, and it took a look at Social Security, and basically the trust fund is going to be depleted in just 7 short years. It's going to trigger an automatic 24% across the board reduction in benefits. Do I have your attention yet? Do I have your attention yet? Because if I don't, maybe this will get it. And this is, of course, if Congress does nothing, which they're experts at doing. By the way, these cuts are going to affect all beneficiaries, including those that are already receiving benefits. And that's very important. That means everyone who follows the panic-claiming Social Security advice given by our TikTok teenagers, take your Social Security ASAP at age 62 before it's all gone. Well, that's not going to save you. That strategy is still at risk of future reductions if you're collecting. So what I need all of you to understand, what is Ron's take on this? Well, first of all, Social Security is going back to its original state. You remember, well, if you don't remember, you look it up in history, Social Security was never intended, when it first launched in the mid-1930s, it was never intended as a primary retirement income vehicle as most Americans are using it today or have become accustomed to think of it that way. And so the U.S. government can no longer afford to leave Social Security untouched. Massive changes are coming. Remember how corporations got rid of pensions and they replaced them with 401k plans. Do you remember that? Some of us are still too young to remember that, but those of us that are, let's say, above 60 probably remember this. What happened is corporations shifted the responsibility of retirement security onto employees. And so the same thing is about to happen to the American public with the U.S. government's treatment of Social Security. They're shifting back the responsibility of retirement back to you. They're saying Social Security can no longer be a primary retirement income source as it is for many Americans. So what this means for you, the message for all of us, and this is Ron's key take here, is you need to plan accordingly. Amass as much money as you can right now as far as savings and retirement, because Social Security 2.0 is going to be less responsible, less involved, and less generous with your retirement income. Hashtag sad but true. Taking a look at broad market indexes and the ETFs tracking them, let's start with the S&P 500, which is up nicely, 9.35%. But take a look at this. Commodities have been a much better performer. SDCI, which tracks a broad basket of commodities. If you're looking for a core, broadly diversified commodities ETF, that's the one. SDCI, 5-star rated. Put it on your radar. If you don't have exposure to commodities, get some, because commodities have been an excellent hedge against higher inflation. We're going to take a look at some other specific charts within the commodities group in a second. Bonds up just about 3.5%. Global real estate picking up some steam, REET up over 6%. And of course, the runaway leader continues to be Bitcoin, up just over 25% in value. As far as S&P 500 industry sectors, there's 11 of them. You can slice them up like a New York pizza, a Chicago pizza, a Detroit pizza, whatever kind of pizza you eat. There's 11 industry groups, and the top ones are industrials, utilities, and technology. But take a look at this. Just from a big picture perspective, you got 11 industry groups up, 0 down. That's very, very bullish. There's nothing bearish at all. If you take a look at the underlying performance of S&P 500 sectors and you put them all together, that's why S&P 500 is up. But even the ones that are lagging, they're up marginally. But again, there's nothing bearish or negative at all about the performance as far as industry sectors go. As far as Ray Dalio, I don't know if you saw, he's been posting a lot of information about his viewpoint of where the U.S. government and U.S. debt stands right now and how this is going to trigger some massive problems ahead. He called it America's got an economic heart attack coming. And he gets my quote of the week. If the U.S. does not cut the deficit 3% of the GDP and do it soon, we risk facing an economic heart attack in 3 years. And Ray is one of the few billionaires who's not afraid to evangelize the ugly math of what the U.S. government faces. It means more tailwinds and more demand for non-U.S. dollar-denominated assets. That's why, and we're going to take a look at those in a second, some of those precious metals like gold, silver, also commodities, assets like Bitcoin, cryptos, as well as tangible assets with finite qualities. That's why they're doing so well. But also from an asset positioning perspective, making sure that you get more money into the tax-free zone. That's things like Roth IRA, Roth 401k, things that shield you permanently from the wrath of dramatically higher income tax rates ahead. That's coming, and it really is the only way that the U.S. government can get itself out of this problem. It's got to be some combination of reduced spending as well as increased revenue, and increased revenue coming in the form of higher tax rates for all, not just for the wealthy. Well, you can't really tax them much more than they're already being taxed. You can't tax the poor. Middle-class America is in the firing line. So now is the time to prepare yourself and to correctly position your assets again in things like Roth IRA, Roth 401k, Roth conversions. This is that chart that I alluded to, looking at some of those precious metals and the ETFs tracking them. Glitter, GLTR, is a basket, kind of a 4-in-1. It includes exposure to palladium, platinum, gold, as well as silver. And it's performed very well this year. All these ETFs up over 20% in value. Of course, IBIT right there. It's interesting to see that GLTR as well as gold incrementally outperforming Bitcoin on a year-to-date basis. And then take a look at Dust, which aims for 2x daily. That's 200% daily leverage exposure to gold miners. This ETF is on fire. Of course, it's been pretty volatile run, but the trend is still up for gold miners, ahead by 125% since the start of the year. So that's been a good trade. I want to remind you all, we talked about Ray Dalio's economic heart attack. Besides correctly positioning your assets from a tax perspective, things like Roth IRA, Roth 401k, and then, of course, things that can protect you against the devaluing of the U.S. dollar and potential implosion of U.S. debt, is to have an invest with what we call margin of safety. This is the 3 what we call cornerstones of a well-built, architecturally sound investment portfolio. You got the core, the non-core, and then the margin of safety. Margin of safety is the part of your portfolio that is earmarked for capital preservation, liquidity, and zero volatility. Your portfolio's margin of safety is not market timing. It's not switching in and out of cash. It's different from your emergency fund. And it's a permanent cushion within your investment portfolio. It's not temporary. It doesn't come and go depending on market conditions. For example, if conditions are great, if it's sunny out, your margin of safety doesn't suddenly disappear. It's like insurance on your home, right? If it's sunny outside and the weather's great, are you going to cancel your insurance on your house? Of course not. Are you going to then scramble to buy the insurance when it starts raining or it's snowing outside, or if there's a tornado or hurricane coming? Of course not. That's foolish. You keep the insurance on the house at all times. And so the same thing goes for your portfolio's margin of safety. It's always there. And by the way, you can quote me on this. Safety is not a luxury. It's a necessity. And everyone, from investment beginners all the way to experienced investors, absolutely need safety. Now, to what degree do you need safety, right? The bigger your portfolio, the more you have to lose, the bigger your margin of safety should be. And especially if you're approaching retirement or in retirement, then you definitely need a much larger margin of safety in dollar terms, maybe not necessarily in percentage terms. And then investors that are still in the accumulation phase, they still need protection, but maybe much smaller in size relative to investors with more to lose. As far as other ETFs, I wanted to highlight individual stock, Palantir Technologies, which has been a great performer, up over 108% since the start of the year. PLTU, which aims for 2x daily performance to Palantir's stock. And we've really seen an explosion in the popularity, trading volume, assets under management of single stock ETFs, which allow you to basically get amplified exposure to some of these best performing stocks without using margin, right? Without going into debt. Some of us don't want to take that risk. And so the leverage ETFs offer you a way, a very novel way to amplify your exposure to some of these great performing stocks. I don't know. Palantir could be, the way it's going and looking, could be on its way to that $1 trillion status. This could be one of the next companies to hit $1 trillion market cap. So if that happens, I expect to see more great performance out of PLTU. At least put it on your radar. One other chart that I wanted to share with you is copper, which has been one of the best performing commodities this year. There's a couple ETFs here in this chart that track copper along with copper miners. CopJ is the copper miners, the small caps for mining stocks in the copper sector. And then you got COP, which is just regular large caps, COP. And then CPX R, which is actually a leverage exposure to copper itself, and that's been a great trade this year. So put these ETFs, if you want to play copper in a concentrated way, on your radar. This particular table I share with you almost every time we do these episodes to remind you of what is the big money doing. How did they get that way? How have they allocated their financial resources? And you can see here, hands and away winner continues to be technology. The wealthiest folks on the planet have their assets concentrated in the technology sector. That's where they've made their money. That's where they made their wealth. And so from an investment perspective, I think that's the orientation that most of us should be leaning our portfolios towards is technology. Things like AI, things like digital assets, cryptocurrency, cloud computing, all that, quantum computing. These are all things that are part of the overall technology, chips, semiconductors, all of that. And you take a look at some of the wealthiest folks on the planet. Again, driverless automobiles, robo-taxis, all that. This is part of technology. This is where the wealth is being made. This is where the wealth is concentrated. So if your portfolio doesn't reflect what's happening right now and where society is headed, then I think you need to take a look at that again. Be sure to check out our playlist for ETFK Retire. ETFK.com, of course, is where you go to get your ETF powered by a 401k plan that accommodates ETFs. And so this is for startup plans as well as those of you with maybe a mutual fund, legacy 401k that want to migrate. If you run a company and you're looking to enhance or improve your current 401k setup, lower the fees, get better investment choices, get started at etfk.com. This is one of the things that we're trying to bring to you as well as the rest of the public. Also, be sure to watch out some of our upcoming episodes. We've got Metals in Motion. We've got more episodes for your First Look ETF coming up, Direction, as well as the USCF playlist. Be sure to check all that out again on our playlist right here at ETF Guide TV. Hit me up in the comment section below. How are you doing? How's your summer going? How's your portfolio performing? I showed you some charts about what some of the major asset classes are doing. Please give me an update. And thanks again for watching. I'm Ron DeLegge with ETF Guide TV. We'll see you on the next episode.